Happy weekend, traders. Sam, the Trader Geek, with you on Sunday, April 26th, 2026. And let's take a look at things and see where we are, where we're heading. And this is your weekly market review and preview, of course. Starting out with the indices between now and 18 months, this chart courtesy of Kirk's Opportunities. And we've got the NASDAQ and leading the way last week, 2.34%. SPY up about a 0.5%. Russell 2000 eking out about a third of a percent gain. And anything that was mid cap or Dow Jones down on the week, as were the micro caps. So rally strong, but narrowing quite a bit last week. But as you can see, for the month of April, lots of green on the screen, with the NASDAQ up 15% and microcaps not too far behind at 12.5%. Dow Jones lagging, as are the mid caps so far this month. On a quarter to date basis, of course, this is the same as the month. So what are we talking about here? But year to date basis, we've got microcaps leading the way about 14%, followed by the small caps at 12.39%. NASDAQ pole vaulting ahead of the S&P is up 8.09% after lagging for most of the first quarter. And you've got the Dow Jones, more of a value index than any of the others, only up 2.42%. But all in the green, and you can see 6 months, 12 months, 18 months, all nicely in the green, with the NASDAQ still leading the way, almost up 35% on the 18-month basis. But actually, microcaps are leading the way. Look at that on a 12-month basis, 62.87%. Really impressive stuff. All green on all the indices. Drilling down into the sectors, mixed bag last week. We saw technology up 4%. Big surprise there. Some big moves in the semiconductors, making new all-time highs. XLE energy up 3.36%. By the way, we'll get to semis, but that was a dramatic move last week. Staples, on the defensive side of sectors, up almost 1%, and materials and utilities basically break even. But healthcare hitting down about 3.1%, as were communications down 3%, and financials. All of these kind of lagging last week. And it goes to show you that the strength in tech and energy, and that's about it. On a monthly, month to date and quarter to date basis, technology leading the way, with energy leading to the downside after a big run in the first quarter. Staples kind of nothing there, but you see consumer discretionary up about 9%. And a lot of that is really Amazon that's in there. Tesla hasn't really done anything month to date, as we'll see when we look at the Mag 7. Real estate bouncing back, up 7.35%. Financials up 4%. Healthcare losing alongside of energy on the quarter. Year-to-date basis, looking good. Energy 27, no one's even close, and technology up 11. You've got materials up 14, industrials 11, with financials and healthcare both down in the sixes in terms of their percent. And over the last 12 months, you can see that technology has reclaimed the lead, up 53.7%, followed by energy 38%. And the weakest among them is healthcare. Again, these defensive sectors not doing too well. Actually, consumer staples is the weakest, and then you've got healthcare in second place. So these are the low single digits in the S&P 500 sectors. Switching over to the industries, Again, another mixed bag last week as we saw breadth in terms of participation deteriorate and favor most of the mega cap growth names, in particular in technology. But good news from the Trump administration on cannabis boosted it about 17%. But I mean, still down on a 6 month basis over the last year, up a bit, but still in the red longer term. Can this really turn it around? Remains to be seen. Oil services and neck and neck with semiconductors up 9% last week. Solar up 5.8, and then oil and gas up there. Towards the bottom of the list, aerospace, space and defense taking it on the chin. Lockheed Martin and Raytheon amongst those, on possibly peace in the Middle East, at least in Iran for the time being, hitting those stocks hard. Space exploration stocks also hitting down 6.69%. Gold miners losing 6%, and entertainment stocks and social media down about 4%. So a really mixed bag, almost half and half, with a lot of in between. On the month and quarter basis, cannabis up 32%, and oil services up 8%. Semiconductors, wow, 32%. And what it looked like a three standard deviation move on the semiconductors for last week. So really out of this world. We've got quantum computing jumping of late, up 24%, and internet stocks up 12%. Whoops. Let me get rid of this. And towards the bottom of the aerospace and defense, down 1.35%. You've got medical devices down 1%. And oil and gas exploration so far this quarter down at 7.58%. On a year-to-date basis, oil services still doing well. Semiconductors up 40%. You've got basic materials up almost 20%. And sprinkles of red throughout here, but none worse than software stocks, still down 19. Can't seem to find a bottom, although they do appear to be bottoming. Medical devices up down 15%. Gaming and sports down 10. Social media stocks down almost 16%. Airlines, surprisingly, are down still about 7.37%, but I guess not so surprisingly when you consider that they're affected by the price of oil. On a 1 year basis, lots of winners here, a lot more green than red, which is good. But healthcare, you can see in the red. Medical devices goes hand in hand with healthcare, down 11.23%. But space exploration stocks, look at that, 128%, along with the semiconductors right up there. So high tech stuff working, including the dinosaur juice oil services up 102%. So you can see a lot of alternative energy up there, nearly a double in 12 months. Solar, almost a double in 12 months. So nuclear energy, anything energy has just been very, very strong in one form or another. And not to mention the gold miners, almost a double on a year-to basis. So lots of really big moves. And again, some of these moves are pretty dramatic. Take a quick look. We haven't looked at this in a while, but size versus value, large cap growth leading the way last week, along with small cap value, which is kind of opposite ends of the spectrum. So you've got the large cap growth and the big ones in the growth and the small ones in value. And mixed bag here, but on a quarterly and month-to-date basis, you can see that large cap growth is definitely leading the way, with the next closest one being small cap growth. And not to be outdone, the mid cap growth. So anything growth has been doing well. year to date, you can see that we're still playing catch up, and therefore small caps, which have been leading most of the year, and really didn't have as big a fall as the rest of the indices, up 13.63%. Small cap value up 13%. And the weakest among them is large cap value. So there you go. The growth trade or the growth initiative is getting back into gear, so to speak. If you look at things on a 12-month basis, small cap value, large cap growth, top of the heap there, with mid cap growth right there in between, but all of them with healthy gains so far year to date and over a 12-month basis. Mixed bag when it comes to global markets last week. Taiwan leading the way, but you can see it's other than a few positives here, mostly negative here with UAE and Spain and Saudi Arabia kind of rounding out the worst of the rest of the world. So it seems to be that the money is flowing back into the States, although most of the rest of the world is still keeping up pretty well and probably and still ahead of the United States, as you can see on a year-to-date basis. We're up 4.7%, and you can see that many other countries are head and shoulders far ahead of the United States in terms of their performance. And same with on a year-to-date basis, some really dramatic and huge moves. Look at South Korea up 177% over 12 months. Taiwan almost a double. This is just incredible moves across the world. Whereas like frontier markets, if you want to call Saudi Arabia a frontier market, it's not an emerging market. You could call it a developed market, but probably frontier is not the right term for it. But they were doing pretty well last year, and not so much this year. India down 6%. So not sure what's going on there, but obviously lagging the rest of the world so far this year and over the last 12 months. Even China, year to date, is negative still and can't seem to get into gear. Germany, pretty much flat, but on a 12-month basis, up 7.6%. Finally, we take a look at the Magnificent Seven, and mixed bag last week. Tesla reported earnings and got hit to the tune of 6%, but rebounded towards the end of the week. Meta losing 2% this week, and kind of affecting the communication sector as well as social media industry. Apple flat. But NVIDIA breaking out, and so did Amazon, reaching a new 52-week high. For the quarter to date, which started on April 1st, Amazon far and away the leader, up 27%. I said in a previous video that I thought that Amazon was going to be destock in the Magnificent Seven to lead the way for 2026. So far, I am proven correct, but I have a 1 in 7 shot of being right. In any case, NVIDIA, 19.42%, Alphabet not too far behind, and Tesla eking out just a little bit over 1%. But year to date, we still have a mixed bag with Microsoft and down 12% and Tesla down 16%. Meta up fractionally with Apple flat, but Amazon leading the way, and NVIDIA still in its winning ways. And if you kind of look back 6 months and you look on a combined basis for the Mag 7, they still have not exceeded their October 29th highs from last year. So we still have some work to do as far as the Mag 7. And as we'll see when we take a look at the earnings schedule for this week, we have 5 of the Mag 7 reporting on Wednesday and Thursday this week. So that ought to give us either a bump or a thumbs down for what's going to happen with some of these prices. And obviously Tesla's already reported, And we're going to wait to hear from Microsoft, Apple, Alphabet, and Amazon this week. On a 12-month basis, they're all in the green, with the weakest of them being Microsoft getting hit, along with all the rest of the software stocks. But look at Alphabet, just far ahead of everybody else, up 109%, over a double over the last 12 months. But NVIDIA, no slouch at 87.6%. Taking a look away from history, let's take a look at the charts. And for those of you that are new to my video, welcome, and I appreciate you taking a look. I like to look at the major indices, the SPX, the NDX, and the Russell 2000 on 3 time frames, the daily, the weekly, and the monthly chart. And what can you say? Beautiful all across all 3 time frames. I'm a top-down trader, so I like to look at things from an index perspective down to the intraday charts if I'm day trading. But what we see here, this line is for the Bollinger Band, upper Bollinger Band. This is the lower Bollinger Band. Yellow line is the 80 EMA. Green line is the 21 EMA. Blue line is the 50 EMA. And we don't see the red line. Oh, there we go. Red line down here. That is your 200 DMA. And I have a bunch of indicators. Chandelier stop, which is a pretty much a volatility type stop, and a PSAR, which is more like a momentum and trend indicator. And we had a new all-time high on Friday, so we were consolidating for about 4 days, and finally breaking out on Friday. Although when I looked at the S&P 100, I think there were 30 stocks advancing and 70 declining on Friday. So that was not very good breadth on the S&P 100 on Friday, but nonetheless, we were able to break out, and that's no small thanks to NVIDIA breaking out, as well as results of earnings from Intel, and then AMD taking off as well on the back of Intel's earnings. We had another breach of the options implied expected move last week. We closed outside of it, and essentially the fourth week that we have done that in a row. So the options implied move last week was about 112 points. This week is about 129 points, because we got lots of fun coming up in terms of earnings and economic reports, and we'll take a look at those in a couple of minutes. But here you have the options implied expected move. Upper edge is around 7,300, and lower edge is around 7,035. And so the expected move has not done a really good job of handicapping what the market's doing. And after about 11 weeks of staying inside the expected move, we've had 4 straight weeks where we're outside the expected move. And obviously that move has been outside of the expected move. We are inside the Bollinger Band, and we could really use a good rest. MACD solidly positive, nothing here to worry about. And we've got an RSI that's basically hugging the overbought level. And that's what you get in a strong bull market, an overbought market that never gets oversold or doesn't really drop below the 70 RSI. And with a bullish chandelier and bullish PSAR stop, here's your where you would break that down. 7,046 would be a close to change that parabolic stop and reverse stop. And then down here for the chandelier stop right there, 69.43. Taking a look at the weekly, just beautiful 3 candles, come back and test a little bit down into the 7,050 area, and we bounced, made a new all-time high, and closed near the highs on Friday. So very impressive. MACD has finally flipped to a buy signal on the weekly, which is nice to see. And MACD, or RSI, is approaching the overbought level at 70. What we want to do is kind of have a situation like we had here. for several weeks in September, where we got overbought, we stayed overbought, and continue on. On a monthly chart basis, all aces still. We have that monthly April candle looking beautiful, and we do have that candle taking out just basically all three. And some people call this a buyer shutoff. You don't get a chance to buy in once this starts moving. And this has been like a freight train. And although, you have MACD here tried to flip negative, it didn't. And now we have kind of a V shape here in the RSI getting up to the 71 level. So bullish, bullish, bullish. There's nothing here that says that this is going to collapse anytime soon. And if anything, we'll get some consolidation. But we do have a lot of market moving events and earnings this week that can give this rally a pause, so to speak. So let's switch over to the NDX. NDX, bullish chandelier, PSAR, just another beautiful candle on Friday. Again, tech was very strong on the back of Intel's earnings. MACD very strong, strongly overbought RSI above the 70 level. Very impressive. We're back inside the Bollinger Band after a few days of consolidation, if you want to call it that. When we take a look at things, we see that there's nothing here that is of concern. We're above all the moving averages. The only concern we have is we're probably stretched above the 8 EMA here and should come back in and try to tag it. So you've got the options implied expected move right there at 20, upper edge at 27,972. Call it 28,000, and the NDX has an expected move of give or take 669 points. Looking at the weekly chart, just another beautiful fourth candle closing really close to the top. We hit 314. We closed at 303. MACD on a buy signal, and we're heading towards the overbought level on the weekly basis, which can persist for a long time. And here we are on the daily chart. We are persisting hard. Bullish chandelier, PSAR, nothing here of concern other than the fact that we are getting a bit stretched and could use more of a break here. But we may or may not get that. But this week will be kind of a pivotal week given everything that's going on to see if we've got a bull trap set or we're just going to continue higher because the chase is on. Bullish chandelier, PSAR on the monthly chart. Just beautiful candle. Can it extend higher into month end? Well, we've got 4 more trading days to tell us, and lots of stuff packed into those last 4 trading days. Regardless, this has just been an incredible breakout, and you got a MACD that tried to flip negative, it couldn't, and now we definitely have RSI back in the overbought area for NDX. So bullish, bullish, bullish. Nothing to complain about here except probably needs a breather. Switching to the small caps, the Russell 2000. More of consolidation than anything last week. We didn't really get anything out of the small caps on Friday. Again, getting back to that kind of poor breadth on Friday. But it didn't stop the S&P and the NASDAQ from going up and making new all-time highs on Friday. The last all-time high was Tuesday in the small caps, and we've just kind of been sideways on there. MACD is definitely positive, though it's giving signs of maybe going sideways pretty soon. And we're flirting with the overbought level. We're at about 69. We were overbought there on the daily chart. Bullish chandelier, bullish PSAR, everything looking positive. And you can see here, we came down and tested the 8 EMA on Thursday and bounced nicely off of it. So looks good. We've got the weekly chart. Again, a little bit of a a doji star, not star, it's just a doji type candle here. And the way I look at this is we go over the top here, we're heading higher. We go to the bottom or below this one, then we're probably going to come back and retest some levels on the way down. MACD flip back to a buy signal, and we are close to overbought on a weekly bullish chandelier and PSAR. Here's the monthly chart, thing of beauty. MACD never really tested to go negative, and so it's been on a buy signal and a beautiful candle taking out the last 3 months candle and showing really good relative strength. And we need to have that. This is 2,000 stocks after all, and this can help show a broader rally. So, but I like what I'm seeing here, that the consolidation here, we bent, but we didn't break, and that's what you want to see. So bullish, bullish, bullish lost time frames. Nothing here to say that we're about to head lower, and consolidation would be a healthy thing. And could it be a bull trap at some point? It always can. We'll see. Switching gears here and taking a look at the VIX, and we closed below 19. And although we're making higher highs on the market, if you want to have one little nit, the volatility, the VIX has not really come down and made a lower low yet. So that's a potential divergence. And take a look here on the daily. It looks like the MACD is starting to go sideways and maybe could flip over to a buy signal on the VIX. So a bullish VIX obviously is bearish for the market, but nothing says that we can't have a few days of a pullback and some rest and consolidation. But we've had for the last 5 days basically sideways movement on the VIX, kind of similar to an opposite of the market sideways action at the top. So, but nothing concerning here. It's 1871, and the VIX is not setting any alarm bells. But the only thing is, it just hasn't set a lower low, and so there is some holding of VIX options or some hedging, and as I'll show you in a second. But we also like to look at the VVIX, which is the volatility of the volatility. And given that we hit new all-time highs last week, I'm surprised that we didn't see the VVIX sink lower. And we are below the 100 level warning track, if you will, the 100 to 110. I call that the warning track. Anything over 110 is something to pay attention to. But VVIX is at the 97 level. We haven't really crushed down to the 80s or the 70s. So this is also saying that they believe in this rally, but they're not giving up all of their hedges just yet. Heading towards and taking a look at the VIX, what I like to do for the new viewers is take a look at the next monthly options expiration for the VIX. And if we assume that the VIX closed at 18.71, we don't assume it did, but let's call it 19, round it up to 19. And what I like to do is look at the out of the money calls in the VIX and the out of money puts in the VIX, and see what they're pricing at. And I like to go to the monthly expiration. I thought it was on the monthly, and see what they price. So if we call this 19 and we go out to the 20s, we're going to buy that one for about, call it 2.25, right in the middle. But if we go to the 18s and buy those, we're going to pay about 46 cents. So the out of the money calls are pricing at about 5 to 6 times the puts. And so this is a feather in the cap of the bears. They're saying that there's more money in the call side of the VIX. And when you're buying calls, you're usually bearish on the market, though I've seen this be as much as 10, 15, 20, 30 times in terms of the differential. So the edge on this one data point goes to the bears since the calls are pricing at 5 to 6 times the puts. And that's not surprising at all, especially when you consider that, although the VIX was down on Friday, I think the VIX futures were up on the day. Let me take a look at the VIX futures. So on Thursday, they closed at 28 at 28. So actually, no, they closed right at the same level. So the VIX futures were unchanged on Friday. I thought they closed a little bit higher, but the VIX, what did I say? I think it closed a slightly lower, 1871 versus 1931. So again, we closed higher on Friday on the NASDAQ and the SPY, but the VIX futures didn't close that much lower than what have you. What am I looking for here? I'm looking for Market Watch and we'll go to visualize, and I want to look at the index watch. So if we put up here the S&P 100, yeah, what we ended up with on Friday, 67 declining issues, 34 advancing on the S&P 500. That's pretty poor breadth. And if we look at the NASDAQ 100, let's take a look at how that ended up. Helps if I pick the right one. Yep, down there. Wish I had a quick button. Mixed bag. I mean, 56 advancing, 45 declining. Not exactly a an indication of strength on those indices, but in any case, it is what it is. If we look at the VIX futures, we can see that we are in regular contango. The farther you go out in time, the higher the volatility, which is what you expect. That more time means more uncertainty, which means a higher VIX. So all this is configured properly, so there's no spot worries in terms of volatility. Taking a look and just confirming the expected move, we look at May 1st. This is a 129 point move, so plus or minus. And when you consider that last week's move was 112 and the VIX declined, well, that tells you something is going on. We have more, a little bit of a higher expected move, despite the lower volatility from week to week. And we can explain it in two charts. And first of all, this is the earnings and economic reports coming this week. We start Monday with Dallas Fed. Tuesday, we have ADP employment. And Wednesday, we have a little something called the Federal Reserve or FOMC rate decision, and Powell's perhaps final press conference coming up, with a bunch of different reports. You have durable goods and housing starts in the morning, and retail inventories, big deal, wholesale inventories. Thursday, core PCE, another Red Star event, if you want to call it that, that does move markets. GDP growth, first read on first quarter GDP, and personal income and spending coming up that day. Of course, we also have initial jobless claims, a traditional, and then PCE. I just said that, Chicago PMI. Friday, we have ISM manufacturing. So a potpourri of lots of important economic reports. One factor in that increased volatility for the week. And you also have lots of earnings. This is the heart of earnings seasons coming up this week, starting with Verizon before the open, and Domino's Pizza in the morning, and then Nucor being the one big one after the close. Tuesday, we start getting into it with UPS, Coca-Cola, Spotify, and GM reporting before the open, and then Robinhood, Bloom Energy, Seagate, Visa, all big names. But really, where the rubber meets the road is Wednesday after the close, and I can't believe they got them all: Microsoft, Amazon, Meta, Alphabet, and thrown in for good measure some burritos and some Mustangs. So there you go. Wednesday, we have the FOMC meeting. We have a bunch of other economic reports. So Wednesday should be nice for those trading volatility. Should be interesting to see what we see with Avis, given all the interest in the trading volatility around that stock. And on Thursday, ConocoPhillips, Caterpillar, Eli Lilly. Um, and then after the close, we got a little company known as Apple and SanDisk, which has been on a tear, as well as Western Digital coming up. So a lot of big names. And of course, Chevron and ExxonMobil reporting on the same date, Friday, usually the second or third week of earnings, which is traditional. And you've got a bunch of other companies. So lots coming up on the earnings front, lots coming up on the economic reports, and hence we have a mere 17 extra points. And when you take a look at the charts last week and we go back here, you can see that with a 112-point move, we had some days where we had 100 points on Thursday, basically 100 moves. Our low was 7,046. Our high was 7,147. Tuesday, wide range bar. So we're getting those 100-point moves, but in this case, we're closing outside of the expected move. So my thoughts are every advantage and every benefit of the doubt goes to the bulls at this point, though consolidation is very likely. Could we get a bull trap? Yeah. Are we heading into less positive seasonality into the end of April, early May? Yes, we are. But there's just so much overwhelming participation, and stuff is just starting to break out. We would have to have some really bad news and bad reactions to earnings to kind of turn this market around at this point. I can see consolidation. I can see a pullback. As long as we hold the 7,000 level, I think we're basically okay. But in my opinion, this week is pivotal. We had 4 weeks straight up, and there's no reason to believe that we get anything more than a pullback, and that there are not people left behind waiting. And unless we get a really, really hard pullback or some really bad news or something happens with the Middle East or anything in the economic reports, I seriously doubt that we're going to get much give back. And I think there will be a lot of people looking to buy any dip here. Because we have a clear ceiling here, I think, to 73 and 7,400 before this could be over. So those are my thoughts. Be careful. Watch your stops. And one of my mentors always says, what's the word? Biases can be a killer. And so if you're biased one way or another, try to set it aside and watch your stops. Do what you have to do to protect your profits, but stay in the game. And as another mentor said, the best way to make money in stocks is to not get scared out of them. In any case, have a great trading week. It should be an interesting one. Bring the popcorn. I appreciate you watching at Trader Geek on Twitter. If you're not following me, give me a follow. And I will see you here next week. Thanks for listening, and I will talk to you later. Bye-bye.